Most people were taught to save money. Put something aside every month. Keep it in a bank account. Don't spend everything you earn. And honestly, that is a good start. But here's the problem. Saving alone will never make you wealthy. Inflation eats at your savings every single year, quietly and without permission. The money you saved 5 years ago is worth less today than it was then. So if all you are doing is saving, you are actually losing ground over time without even realizing it. Now, before we go any further, I want to ask you something. Drop in the comments right now. Are you currently saving, investing, or doing both? I read every single comment, and I genuinely want to know where you are on this journey. And please stay with me until the end of this video, because toward the end, I am going to show you the one mistake almost every new investor makes in their first year. And it silently costs them thousands. That part alone is worth the full 8 minutes. So let us talk about what it actually means to cross the line from saving to investing, and how you do it step by step, without gambling your money away or needing to understand complicated financial jargon. The first thing you need to understand is the difference in mindset. Saving is about protection. Investing is about growth. When you save, you are holding money. When you invest, you are putting money to work. Think of it like this. Your savings sit in a room doing nothing. Your investments go out, join the economy, participate in businesses and assets, and come back to you larger over time. That is the fundamental shift in thinking that has to happen before anything else. But you cannot invest what you do not have. So step one is building what is called a financial foundation. Before you put a single naira or dollar into any investment, you need 3 things in place. You need to have cleared any high-interest debt, because the interest on bad debt grows faster than most investments return. You need a budget you actually follow, even a rough one, so that you know money is coming in consistently. And you need an emergency fund, typically 3 to 6 months of your living expenses, sitting in a liquid savings account that you can touch without penalty. This emergency fund is not an investment. It is your safety net. It is what keeps you from being forced to sell your investments at the worst possible time because life threw you an unexpected bill. Once those 3 things are in place, you are ready. And here is where most people stall. They think they need a large sum of money to start investing. That belief has kept more people poor than almost any other financial myth. You do not need a lot. You need consistency. Starting with a small, regular amount and building the habit is infinitely more powerful than waiting until you have a large lump sum. Step 2 is understanding where your money actually goes when you invest. There are really 3 broad categories most everyday investors work with. The first is stocks, which means you are buying a small ownership stake in a company. If that company grows and becomes more valuable, your stake grows in value too. The second is bonds, which are essentially loans you give to governments or large companies in exchange for regular interest payments. Bonds are generally more stable but grow more slowly. The third is funds, things like index funds or ETFs, which pool your money with thousands of other investors to buy a wide range of stocks or bonds automatically. Funds are where most experts tell beginners to start, and there is a very good reason for that. When you buy a single stock, you are betting on one company. When you buy an index fund, you are betting on the entire economy. History has shown over and over again that economies grow over long periods of time. They dip, they crash, they recover, they hit new highs. An index fund lets you ride that long-term wave without needing to pick the right individual company. Step 3 is opening the right account. This part confuses a lot of people because the terminology varies depending on where you live. But the concept is the same everywhere. You want a tax-advantaged investment account if one is available to you. An account where either your contributions reduce your tax burden today, or your gains grow without being taxed over time. In the United States, this looks like an IRA or a 401k. In the United Kingdom, it is an ISA. In Nigeria and many other African countries, there are pension structures and regulated investment platforms that offer some level of tax relief or structured growth. The point is, before you just hand money to any platform, understand how that account is taxed and what protections it offers you. Use a regulated, licensed platform. Never invest through someone you found on social media who promises guaranteed returns. I will say that again, guaranteed returns do not exist in legitimate investing. Step 4 is automation. This is the single most powerful behavioral tool available to any investor, and it is almost always overlooked. The moment you get paid, a portion of your money should move automatically into your investment account before you ever see it or touch it. This is called paying yourself first. When you automate your investing, you remove the temptation to spend that money. You remove the decision fatigue. You remove the need for willpower. The investment just happens. Every single month, like clockwork, even if the market dips that month, you are buying in at a lower price, which actually benefits you in the long run. This strategy is called dollar cost averaging, and it is how regular people with regular incomes build genuine wealth over decades. Step 5 is the part most people skip entirely: learning the basics of how to read your investments. You do not need to become a financial analyst. You do not need to watch stock tickers all day, but you should know how to log into your investment account and understand what you are looking at. What is the total value of your portfolio? What is your annualized return? Are your fees eating into your gains? Most investment platforms now have clean dashboards that show you this information clearly. Spend 15 minutes every month just reviewing where things stand. That is all. Do not panic when values drop. Do not get euphoric when they spike. Stay steady, stay consistent, and keep your focus on a time horizon of at least 5 to 10 years. Step 6 is increasing your investment rate over time. Starting at 5% of your income is fine, but every time you get a raise, receive a bonus, pay off a debt, or find a way to reduce your expenses, redirect some of that freed up money into your investments. The goal over time is to get to a place where 20% or more of your income is being invested. That number is not unreachable, it just requires incremental progress. Every small increase compounds on itself over years. Now, I promised you earlier I would share the mistake that quietly costs most new investors thousands in their first year. Here it is. The mistake is panic selling. Markets go down. Every single serious investor you have ever heard of has watched their portfolio drop significantly at some point, sometimes by 20%, sometimes by 40%. The investors who become wealthy are the ones who did nothing during those drops. They stayed in the market. The investors who lose money are the ones who could not stomach the paper loss, sold everything, locked in their losses, and then watched the market recover without them. Investing requires emotional discipline more than financial genius. The strategy is simple. The execution, especially when fear kicks in, is where people fail. The path from saving to investing is not complicated, it is sequential. First, you build a foundation. Then you understand what you're buying. Then you open the right account. Then you automate. Then you monitor without overreacting. Then you gradually increase what you put in. And then, over years and decades, you let time and compounding do what no amount of hustle can match on its own. The people who are financially free in their 50s and 60s did not win the lottery. They did not find a secret stock tip. They started, they stayed consistent, and they never stopped. That is the whole story. If this video helped you see the path more clearly, subscribe and turn on notifications because every week I break down financial concepts exactly like this. Clearly, simply, and practically. And again, drop in the comments whether you are currently saving, investing, or both. Let me know where you are and let me know what topic you want me to cover next. I will see you in the next one.